high wages led to high levels of demand and consumption. It promoted consistently high investment, and there was new technology available to raise productivity and both expand production but also raise its intensity, its level of productivity. But like all periods of capitalism, it came to an end. What was favourable in one period gradually reversed itself, and after around 1965 or 1968, depending which country you're referring to, there began to be a decline of profits. That there was a position where increased investment no longer produced the kind of increased profits that the capitalist class demanded, and that was the beginnings of what I'll explain a bit more in a minute. We regard as a crisis of over-accumulation, where capitalism has reached the point, or the accumulation of capital has reached the point where it can no longer produce the profit returns that are demanded by the capitalist class. Now, this is very, as I said, a very sketchy history. But then there was a period after that where the capitalist class faced a period of international turmoil. There was inflation. There was also low growth, so it gave rise to what was termed stagflation, of an unusual combination of very low growth combined with very high inflation. It was very largely due to the international money system, and particularly the dominant position of the US, which was using deficit spending to finance the Vietnam War and other overseas expenditure. And the capitalist class was forced to reassess its position. And then they turned, to cut a long story short, they turned in 1979, 1980 to a new policy, which was at that time termed monetarism. And Paul Volcker, who was the head of the Federal Reserve Bank in the US at that time, and the strategists of the capitalist class determined that they were going to squeeze out inflation by hiking up interest rates to very high levels. And in other words, it made it very painful and expensive for anyone who owed money, because the debt suddenly became much more burdensome in real terms. And on the other hand, it became extremely good for anybody who had hoards of cash or hoards of financial assets, like who? Bankers, the super rich, big financial institutions, and some big corporations who also hoarded money. Now, this was a marked turn from the conditions of the post-war upswing, and it also marked what has dominated the last period since 1980 in various ways, not going through various stages, but since 1980, to pick on a fairly useful date, the world capitalism is being dominated by the financial sector. It began to grow, and then it actually became completely dominant in the period, as we've seen, of since 2000, 2001, where it's grown to a grotesque extent, and that is really the underlying root, if you like, of the character of the current crisis in the economy. Now, I give some periods which you don't need to go into too much, but after 1980, up really until, well, I say 2008, but it obviously didn't come to a complete end last year. There's still strong elements of neoliberalism and globalization, but we refer to it as neoliberalism, which means a return to free market economics. The idea that, for instance, Greenspan in the Federal Reserve particularly promoted that the market solved all problems. And we also refer to globalization, which is a very loosely used term, but it refers to the intensified integration of the world market of capitalism. Capitalism, since its very beginning, has operated on a global scale, but obviously it's grown in significance in a big way. could someone, is it all right? Yeah, okay. So, as I mentioned, the globalization, not globalization, but mainly what we should term financialization, the growing domination of finance capital, the growing integration of the world market, the intensification of neoliberal policies, which didn't just happen, but were actually imposed globally, partly through the pressure of financial markets, but also through agencies like the IMF, the World Bank, OECD, etc. But that went through a series of stages, which I've noted. And that what we can say is, in summary, is that after each crisis, the solution of the capitalist class was to pump in more liquidity. That means they made available more capital, more money in the national and the international economies in order to compensate for a crash either on the stock exchange, as in 1987 when there was a massive stock exchange crash, or in 1997, for instance, there was a crisis at that time of a massive hedge fund, long-term capital management, which, because of its interconnections with the banking system, threatened a catastrophic meltdown, and the Federal Reserve pressured other big banks to come together to bail them out, and Greenspan at that time pumped in more money. There was the collapse of the so-called dot-com boom, the bubble in technology shares in early 2001, and then after the attacks on the Twin Towers and the Pentagon in 2001, there was a slump on the US and other world stock exchanges, and then that led to a massive injection of funds, of interest rates being brought down effectively to near zero if you take into account inflation, and also unleashing the money supply, where money supply was growing by 20% a year in some cases in the US, which was a phenomenal flood of credit. Now, some commentators now, and again, if you read quite a lot of books and articles at the present time, that Greenspan used to be, God, the biggest guru of economics and finance and so on, that he was credited with,